Hey, hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that's going to be talking about economic data, how that impacts the markets with a little market analysis, and then ultimately talk about some strategies that we could implement into a portfolio based on these assumptions we come up with in this market analysis and this video. So without further ado, let's get on with it. What's been going on? It's been a lot, to be quite honest, since we talked last, which was just only 24 hours ago, really. We got a couple of numbers out later in the day that I wasn't able to talk about. The pending home sales yesterday coming in at a negative 8.6%. We knew we were kind of battling an uphill battle with that one. I talked about it before. We saw the new home sales came in a lot lower. We talked about the higher interest rates. My friends that have a mortgage company, they are laying off people because of the slowdown here. The other thing that really flipped the switch yesterday is we saw a real sell-off on some of these negative numbers there, but the wholesale inventories number really kind of flipped the switch on people thinking, you know what, these manufacturers are building up because of the PMI, and they saw this demand. So that got the markets to get a little bit of a turnaround. And then we also got the crude oil inventories number. That was a drawdown of 4.5 million barrels, about 3 million barrels over expected drawdown. So that should have given crude oil a little bit of a lift here. It did. We started seeing some strength there. The market started turning around. Equities started moving higher. Then the Fed funds came out, right? The Fed came out and started talking about interest rates. We were talking about this, how it was a toss-up between a 75 basis point move and a 100 basis point move, 1 percentage point. Well, they came out and did 75, which was expected. The market actually celebrated that. A couple of things went in there where we were hearing what they were, or we read what they were writing about and forward guidance. They made it sound like they were still very concerned in the statement that they had written about inflation. Now then, turning when they started interviewing these folks, well, a couple of them started descending and saying, hey, we're at neutrality now with the interest rates and inflation, which, you know, I don't really see where they're coming with that. But that was something that the markets took a hold of, and we started rallying quite nicely off that bottom there and into the end of the day. Today, we're coming in with some more economic data. This is the GDP number everybody's been looking for. This is going to tell us whether or not we are in a recession. 2 numbers in a row in negative territory does signal a recession, and we've gotten that with the advanced GDP number. Remember, last month came in at negative 1.4. They revised that down 0.2 to negative 1.6. Well, this month we were expected to see a little bit of a positive move. A lot of people started thinking that we were going to get another positive number because of the wholesale inventories numbers and these manufacturing numbers. So it started getting folks to think that, hey, maybe we aren't necessarily looking at a recession. That number was supposed to come in at positive 0.4 now. It came in at negative 0.9. So a big miss on that number. As a matter of fact, 2 in a row there. We then got the advanced GDP price index, right? This is going to be our inflationary gauge. The advanced GDP is going to be how the economy is faring against inflation, if you will. So we're going to compare that, the change in our economy here versus the inflation adjusted goods, causing this number to go into negative territory there. Then we got like I said, the advanced GDP price index showing up as to why we're seeing these bad numbers. Comes in at 8.7, folks, higher than last month's 8%. They revised that up to 8.2. But something to note here, this number continues to really climb, and it doesn't seem like it's slowing down. We're not getting any pre from crude oil over here. This continues to climb. That's going to exacerbate this inflationary pressures. So that said, looks like the economy is going to have to start slowing down here unless something's done about crude oil. All the Fed governors, everybody I've heard talking is saying that inflation has not really slowed, and they don't really expect it to slow too much more here going forward. Increasing interest rates could help that, but really, folks, what's really causing the inflation here is the tax on the consumer with crude oil. Everything that we move, everything that we buy pretty much. This pen has crude oil byproducts in it, polypropylene, and things like that. So we are very dependent on crude oil. It's not going anywhere anytime soon. The problem here is that we need to at least signal that there is going to be more supply coming into the market. Yes, we are producing quite a bit right now, but the supply issue or the supply constraints going forward, increasing demand, is causing this price to move higher and really exacerbating all the inflationary aspects we're looking at here. Now, bonds continue to climb here. They're still saying the Fed is going to overdo this. They are probably going to slow down a little bit. I don't think that they're going to be going at these massive clips of 75 or even thinking of 100. I think it's going to start slowing down to maybe 25 and 50 to fine tune this number here. If they keep dropping the hammer on it, they're going to really, they're going to break something. So bonds continuing to move higher while the short end of the curve is moving lower. Because remember, it's the teeter-totter effect, folks. If the price goes higher, that means the interest rate's going down. So bonds, we're seeing price go higher and the interest rates are going down right now. Fed fund futures, they're driving interest rates higher, which is pushing price down. Okay. Now on to gold here. Gold finally getting a little bit of a move to the upside. It's finally believing maybe that inflation is here to stay and that folks need to put that money to work. We've been talking about this. Institutional traders, a lot of people during this last sell-off, raised capital by selling their stocks and most of their portfolios, kind of trimmed those down a little bit. Markets come off a little bit here now, right? Usually what we've seen in those types of sell-offs is that folks will put their money to work. They'll put it into a safe haven, whether it's bonds, gold, storers of value. And gold is typically a inflation adjusted storer of value. As inflation rises, we usually see gold moving higher, but that's not been the case recently. And it's been a real tough time for me to really figure out why this isn't moving higher, but it looks like now we're going to start seeing gold make that move to the upside. I talked about this off these tweezer bottoms. That would be the opportune time to start looking at adding. Anything breaking below that would be your stop, right? So with this market moving higher, I think that we're going to come back to at least 1800, which is very close to that, or is the value area, and very close to that 50-day simple moving average. So finally going to start seeing gold move higher here. One thing I didn't mention here is two negative GDP numbers, advanced GDP numbers in a row does signal we're in a recession. So this is a quarter over quarter thing. And we have gotten two in a row. This one was expected to come in a little bit higher. And I think that with everything else going on with the PMI, some of these manufacturing numbers, it doesn't really feel like we're necessarily in a recession, despite the fact that the numbers kind of quote unquote say that. With that said, the demand for labor, everything else is still there. There's still a lot of business happening and folks are still trying to get business done. It's very difficult with the tight labor market. Some folks just are having a lot of businesses are having trouble getting their companies to full employment. I was talking to somebody who is working a company and his whip is expected to have, I don't know, like 50 more employees than what he has. He's trying to hire as hard as he can. He's doing advertising on radio, TV, and the papers, and he just cannot get enough bodies in the door to fill these positions. So while the folks are talking about jobless claims and everything else doing very well, it seems like the economy wants to move and wants to move quickly, but there's a lot of headwinds that are going on. And some of this has to do with the labor markets. Bitcoin trying to claw its way up. It created a new little point of control down here, as you guys can see. That's probably where people are putting their money where their mouth is, folks. It's buying, that is volume trading down at these levels. So quite a bit of volume. So I think that this is a support level that folks could get involved in, look to get out anywhere below 18,400. We could even call it 18,500 if it breaks below that too far, would be the place where I'd pull the ripcord. But having the point of control right here where we currently are, it could easily just flutter back and forth here, but I think the risk for Bitcoin, gold to the upside. Bonds still looks like the risk is to the upside. Crude oil, risk to the upside. Equities, let's talk about that. Yes, we've gotten a big rally off of yesterday's numbers. I think we're going to see a little bit of a pullback here more recently going into even next week. I think that we're going to start seeing some of this momentum to the upside start to slow down. Now, remember, we are looking at lower lows and lower highs. This high was probably the high that is going to be mostly looked at for breaking this downward pattern. We're trying to claw our way out of it. We haven't quite gotten above this bit of a line in the sand. So if I have my marker up, I'll just draw it kind of dirty. I'm not going to, right there. Let's just draw a line right there. That's kind of the line you would be looking for, 13,000. Let's just call it in the NASDAQ. A break above 13,000 will break this negative pattern and would get me on the bullish train there as well. You know, I have been adding things to my portfolio by selling puts. I've gotten long Las Vegas Sands, Yum Brands, and a couple of other things by selling those puts. And I'm fine with that. I'm going to start to look to cover calls, lower overall cost basis. I mean, seriously, folks, these levels are pretty darn good levels to at least start to enter. I'm not saying we go both hands buying or selling puts at that level. What I want to do is start layering these in at this level. We break down there. If I get put those stock, then I'm good with that at these levels. We talked about my levels with IBM and that price level. I'm happy to do that because historically that's been a good place to buy it. That said, anytime you get these rallies, that's when we're looking to cover the calls on those stocks that we own. Pullbacks, look to sell puts, add opportunities that way. What was I looking at? NASDAQ, Dow Jones Industrial Average is stronger than the rest of the markets. We did get it to break above that previous little high there. This is not a surprise, folks, as we're in recessions, things like that. Folks are going to put their money in blue chip stocks that are bellwethers, if you will, and have proven that they are going to last throughout time, if you will. So that's the ones that usually go into the Dow. That's going to be the ones that everybody knows and are going to invest in. So Dow Jones obviously going to be getting that push to the upside there. E-mini S&Ps are making this grind higher. We've gotten above that 50-day simple moving average. But today, I do think today and tomorrow, we could see some weakness heading into the weekend here. All right. So keep your eyes out for that. This would be a day where I'd be looking to cover calls on most of my markets. We've gotten a couple of days of higher moves. That's going to allow us to take advantage of this high volatility, lower cost basis on stocks that we've owned. And that's exactly what I'm doing here, folks. Staying mechanical, continuing to trade, continuing to add things to our portfolio, and lowering cost basis. That's how it's done. That's how we're going to do it. And if you can't do that, take it easy. Bye for now.